Hey everyone, it's Mark Ferguson with Invest for More. Welcome to the real estate video. Today I'm talking about one of the bigger mistakes I made in my career as a real estate investor, and that was paying off this house you're looking at right now early. I paid it off about 3 years after I bought it. I was incredibly proud after doing that, and shortly thereafter, I realized it was a pretty big mistake doing that. I'm going to go over the numbers, show you why, and show you maybe what could have happened if I didn't do that. And you can see I paid very little for this house in 2010. This is my very first rental property I ever bought. And then we'll show you what I sold it for as well later on. Now, of course, check out investformore.com for much more information on my flips, rentals, being an agent, all that great stuff. That is my blog. And I have a new book coming out here soon to go along with my 9 other books. If you want to check those out, those are on Amazon. Most of them are paperback, ebooks, and audiobooks as well. And let's talk about this property. So I bought this in 2010. I actually got the money to buy this property from my personal house. So I bought my personal house in 2009, got an amazing deal on it, paid $210 for it. It was a foreclosure. And then about a year later, I refinanced it, took $50,000 cash out, tax-free because it's a loan. And I used that money to buy this rental property and then another rental property later on in 2011. And that's kind of how I first got my start buying rental properties. Now, at the time, a lot of people were telling me I was crazy. I should not be buying rental properties. It's the worst investment I could make. Everything's going to crash again. But I decided to go against the grain. And after tons of research and reading books and everything, I knew rental properties were for me. So when I bought this property, I spent maybe $2,500 repairing it. So there's no real pictures here. And the picture they used was from 2008. But anyway, it needed like a little bit of paint, and that was it. I think I bought it, rented it for $1,050 a month. I paid $96,900 for it. As you can see, it was a fantastic deal and worth way, way, way more than that now, of course. But back then, it was probably worth $125,000 to $130,000 after I did a little bit of work to it. So I always like to get great deals. This was no exception. This is a really good deal when I bought it. It was an estate sale, and really cool first property. I have lots of videos that show the inside of it and updates throughout the years. Although, like I said, I did sell it in a 1031 exchange, bought a big commercial property with it. Now, why was it a mistake paying off this property? Well, first off, let's take a look at what my loan was and how I bought it. I put 25% down, which I'm on bank rate mortgage amortization calculator. I love this calculator. But anyway, we'll get out my other calculator here. 96,900 times 0.75. So I put 25% down, which I really shouldn't have done either. That was another mistake. My mortgage broker at the time convinced me to put 25% down instead of 20% down because it saved me like an eighth of a percentage point on my interest. And that was $5,000 I could have used to invest and make way, way, way more than that. But anyway, I learned my lesson. So I had a loan of $72,000. Oh, what was that? I left too quickly. $675. So that's after putting my 25% down. Then I also had some closing costs I had to pay. I think they paid some of my closing costs for me, though. The cool thing about this is we can go back and look. This says no, but it had some of my other information wrong in there as well. So I think they paid some of my closing costs for me, too. But anyway, I had a 30-year loan, fixed rate, and I think it was actually about 4.5%. Rates were higher back then than they are now, although rates are starting to creep up a little bit. I think it was 4.5%. My payment was $368, if you can believe that. That's crazy, right? Now, that doesn't include taxes and insurance. Taxes in Colorado are super low. And if we go back here, we can see $659 a year. A year were my taxes on this property. So that's like $50 a month. My insurance was probably $800 to $1,000. So I had maybe $150 more for taxes and insurance. So if we do 368 plus 150, my payment was like $500 and some dollars with taxes and insurance. I rented for $1,050 a month. So I was definitely making money. Now there's always maintenance and vacancies you have to account for. But this house had very little of those over the years. So what my plan was when I bought this property was to snowball all the rent from my other properties into paying off this loan early. So the cool thing about this bank rate site is you can click that little amortization schedule, and it'll show you how much of your payment goes to principal, interest, what your balance is over the next 30 years. So you can see, I wasn't paying off a whole lot of principal, and a lot of my money was going to interest, and people will say, oh, you need to pay that loan off as fast as you can. Look at all this interest you're paying. You're wasting all this money. The bank's making money off you. I'm like, kind of. But there's worse things you can do than pay that interest. I'll show you how. I had, I bought another rental property in 2011. I think I bought 2 or 3 more in 2012, 5 more in 2013. And each one was kind of making $400 to $500 a month after expenses. So my thought was, okay, I'll take all the money I'm making from this one, I'll take the money I'm making from my next one, I'll take the money from the next one, and now I've got, not that much. Here, we'll make this easier. 400 times 4. Oh, wow. Okay, 400 times, there we go. I'm making $1,600 a month off my rental properties. I'll take all this money, plus maybe some extra money I'm making, in my real estate business, and pay this loan off. Because I don't have a paid off property, I'll be making so much more money. So if you multiply this by 12, at $20,000 a year, and that's about right. It took me about 3 years to pay off this loan using cash flow from my other rentals. And like I said, I probably spent some more money from my real estate business to pay off this loan. So what did that do for me? Well, you can see it saved me $368 a month. So I spent about $70,000 to save $368 a month, which comes out to about $4,400 a year. Now, let's divide that by the 70,000. So maybe it was saving me 6% a year after I made all those payments, paid everything off. That wasn't a very good idea, because what happened to real estate prices? Okay, so we're looking at the Fred St. Louis data of housing prices over the last 50, 60 some years. We're going to bunch that up, make it a lot bigger. So here you can see the drop we had, the increase we've had. Here's where I bought that property. Well, actually, Q4, right here. Right there's where I bought that property. And then you can see things were kind of level, and then prices went up very quickly, very fast. And this is actually nationally, and in Colorado where I'm at, prices went up higher than this. This is just nationally. And so I was spending money to pay off this $368 payment, and people say, well, that saved you $4,400 a year. That's a great idea. Now you have all this extra cash flow. May have saved me $4,400 a year, but how much money did it cost me? Because I was using that money to pay off a loan. I could have used that money to, buy 2 more rental properties, at least, maybe 3, depending on how I did it. We'll assume I buy 2 more rental properties. And the thing to consider is I always get a really good deal when I buy my rentals. So right off the bat, I probably would have had $30,000 in equity on both properties. There's $60,000 of equity I could have had by not paying off these loans and using that money to buy other rentals instead. Now, okay, $60,000. Maybe we'll keep track of this somewhere. All right, so I just opened here money or equity. We'll do equity from buying $60,000. That's 2 properties. Now, what else? Well, each of these rentals I was buying was making me $400 or $500 a month. So, I mean, it doesn't take too much thinking to figure out that if I bought 2 properties that are each making $400 or $500 a month, it's probably better than saving $368 a month. So we'll say 400 times 2 you're making $800 a month in cash flow. You multiply that by 12, we're making $9,600 a year. There we go. But that's not the only advantage either. We've got equity, we've got cash flow. What about the loan payoff, right? Remember, we came back here in our amortization schedule, said we're paying off 95. This keeps going up every time you pay off a little bit of the loan. You keep paying off more and more. After 2 years, we probably have 100. Well, after 1 year, we'll just make it a round number, $100 a month. You're paying off $1,200 a month times 2 properties, and that's $2,400. So loan pay down. Oops. $2,400 a year. This is from 2 properties, don't forget. There we go. Okay, so that was a nice advantage. Well, something else to consider is when I have that loan, the interest is deductible too. So that $270 some dollars I'm paying in interest a month, so 270 times 12, that's deductible. Now, you don't get to save that whole amount, but if you multiply it by my tax rate, which I don't know what it was back then. We'll just say 30% to make it even. That's $1,000 a year in taxes I can deduct because I have that loan in place. So having that loan actually helps with the taxes a little bit too. I'm not going to put that number in here because that's kind of a iffy, squishy. I don't know how to explain it, but I'm just going to leave that one out. That's bonus. We'll think of that as bonus. But then there's the idea of not only do we have equity from buying, but housing prices went up a lot. So this is a trickier one too, but we're going to go back to here and scroll through. That's when it was first built, I think. Yep. Here's when I sold it. I sold it in 2019 for $275,000. It's probably worth $350 now. We're in 2022. Prices have gone up. But when I sold it, I bought another commercial property for $610 or $600. That property is now worth probably $900,000, maybe more. So the new property went up more in value than this one. So it's still a good idea to do the exchange, I think. But anyway, so the value went from, now remember, we're counting equity that I gained from when I bought it. So we're not going to go all the way back to 96,000. We're going to say like 275 minus 125,000. It gained 150,000 in equity over about 9 years. So if we divide that by 9, I know I'm doing really basic rough numbers. It gained about $16,000 a year in equity. Now, it wasn't flat. It wasn't like every year it gained 16. It's kind of more of an exponential curve that went up like that. You can see my mouse. So we're still going to put that in our numbers right here. And this is just for 1 year, right? Now, that won't happen every year. You can't expect that to happen every year. We've been in a special market, but this is what actually happened. So that's why I'm using that number. So we have cash flow, we have appreciation, we have equity from getting a good deal, we have loan pay down, all these advantages of a rental property. Plus there's tax advantages. Not only the tax advantage of the interest on the loan, but you can depreciate the structure of the property. So if we say that property structure was worth $80,000, you can't depreciate the land, just the structure. So we're just randomly assigning a value. Please talk to an accountant about how to do this for real. And you divide that by 27.5. You can depreciate over 27.5 years. You get $2,909 a year. You can depreciate from your taxes, which again, you would multiply that by 0.3, is saving me $872 a year in taxes. So that one, from those 2 rental properties, right, we'll multiply it by 2, about $1,700 in tax savings from depreciation. Again, that's tricky too. Whoa, what's going on here? Because you do have to pay that back if you ever sell. If you do a 1031 exchange, you don't. But if you sell it, don't do a 1031 exchange, you will have to pay that tax savings back. But a lot of times it's at a lower rate. And if you happen to die with the properties, then you might not have to pay it back. But it is still something you can deduct from your taxes right now. So overall, by buying these two properties, we'll redo this here. We have $60,000 plus $9,600 plus, oh, why didn't anybody yell at me for doing my comma wrong? There we go. How many people was that bugging while I did that? Now I don't remember which ones I put on here. Okay. Well, I should remember it because it's a very easy number. All right. Plus 2,400 plus 16,000 plus 1,750. $89,750 is how much I could have gained from buying two properties, and that's just in the first year, right? Now, you won't make that much every single year because you only get the one-time equity gain from buying below market value. This is every year and will increase, right? With rents going up. My rent on that property right now, if I rented it, it's probably $1,800 a month, not $1,050. So I have way more cash flow now. The loan pay down, that keeps actually increasing each year. The more you pay down, the more you pay off. So that would keep increasing. Appreciation, and then tax savings. So overall, I was able to pay off a loan in 3 years that was costing me about $4,400 a month. And that that was principal and interest, right? That wasn't just interest. Just interest was much lower than that. It's actually, let's see here. What was that number? Someone tell me, pretending like I can hear you. $750. Total savings. So if we go back to my loan amortization, we're paying $272 in interest. So really, $272 times 12, $3,200 a year is what that property was costing me and what I was able to save by paying off the loan. And that's ignoring that tax savings from the interest, which we talked about earlier too. This is how much I would have made had I bought two properties instead with all that money I saved. The other really interesting thing is prices have gone up even higher since 2019. So this appreciation might even be more than that if we calculate that number. And this is what I mean by it's not just this number and what you're paying the banks and how much interest you're saving, right? That's just one part of the equation. You have to look at what that money could make you if you invested it. Now, if you can't buy rental properties, if you have no way to invest, if there's no way you can make 6 or 7% interest, sure, maybe paying off the loan is the best thing you can do. However, if you know how to buy rental properties, get a great deal, get great cash flow, pay down, use leverage, have properties that go up in value, and then the tax savings, I shouldn't have to tell you which one is better and why I realized I made a huge mistake shortly after paying off that rental property. So what did I do? I went to the bank. I got a line of credit against it almost immediately for like $120,000. Used that money to buy more rentals, flip more houses, and invest that money in things that make me much, 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 much more than this savings right here. So that is why I say it was a mistake for me to pay off this rental property early. Why I don't pay anything off early now, pretty much. Because I know I can save that money, take that money, invest it in something new, and make so much more money than paying off that low interest rate loan. And interest rates are even lower now. Like I said, they're creeping up, but they're still lower than what I paid for that house. It's been an amazing investment, gone up in value, rent was going up, and this loan, that's another thing to consider here too. Inflation, right, makes that loan payoff less valuable over time as well. That $378 or whatever it was worth a lot more money back in 2010 than $378 is worth today. So I have all my cash tied up in this property, and basically the property's going up in value. That's good, right? We like that. But all that cash I have tied up in the property that I use to pay it off is kind of going down because I was just saving this little bit of money, Whereas when I would have bought these other properties, I could have used that money to have more properties going up with inflation and rent going up with inflation, and using inflation to my advantage instead of paying off loans, which actually goes against inflation because you're taking cash to save money when it's worth more instead of paying money on that loan later on to the future when it's worth less, if that makes sense. If I would have kept this loan for 30 years, right, my $378 payment in 30 years would be like $200, $150 in value at that point in time because of inflation. So if you can get 30-year rates locked in, there's really no point in paying off those loans unless, like I said, you have absolutely no other place to invest your money where you can make a lot more money. All right, thanks for watching. Hope you guys enjoyed my little breakdown on one of my bigger mistakes. I learned not to do it again. And love to see the likes, comments, shares. Let me know what you think. We'll have many more videos actually showing my properties, flips, rentals, all that stuff. I know I've had some audio issues with my camera lately, so ordered a new mic. Hopefully that fixes it. Hopefully it's not my camera. I can also use, some other means to record sound as well. So don't worry, I'll still be around doing videos, and I'll try and fix those issues as well here soon. Like I said, love the support. We'll be back again here soon. Take care.